Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 2. This is Section A2, and this is an application topic. Prepare a draft engagement plan for specific processes, accounts, or classes of transactions, considering the prior period and changes in the current period. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. If you sign up for that, we will teach you in 1 hour and for free how to pass the CPA exam by showing you the key ingredients to passing the CPA exam so that you don't waste months or even years of your time. After you watch that, you're going to want to learn more, so make sure you also check out becoming a pro member of SuperfastCPA. Pro members of SuperfastCPA get access to the Pro course, where Nate explains in detail exactly what you're supposed to be doing every single day. It's kind of like a much more in-depth version of the 1-hour training webinar. And SuperfastCPA Pro members get access to the full 10-question versions of these 5-question videos. So to make that clear, in this video, we're only going to be going over 5 questions, but SuperfastCPA Pro members will get access to the full 10-question version of this video so that they can get a little bit more practice and a little bit more understanding. So again, make sure you check out the webinar and make sure you check out becoming a pro member. Now, with all that said, let's dive straight into the questions. All right, here we are at question 1. Let's just dive straight in. Something I always like to point out is reading the last part of the question first. This frequently gives you context for what the question is talking about, so that you can then read through the rest of the question and kind of have an idea for what you're supposed to be looking for, and you can kind of already be thinking of an answer by the time you get to the bottom. So let's read the last part of the question first. What action should the auditor take when planning the current audit? Okay, let's go up to the top. An auditor is preparing a draft engagement plan for the audit of a manufacturing company. During the review of the prior year's audit, the auditor notes that there were material misstatements in inventory valuation due to errors in cost allocation. Again, what action should the auditor take when planning the current audit? So let's read through the options. Option A, reduce substantive testing for inventory since the prior period's audit already identified the issue. Option B, increase the focus on inventory valuation, considering it a high-risk area for material misstatement. Option C, assume the issue has been resolved and allocate audit resources to other accounts. Or option D, exclude inventory from the engagement plan because the prior misstatement was corrected. Now, out of all these options, typically in audit, you can kind of narrow it down to 1 or 2 options. So if you just pause the video, I bet you could think through this and kind of pick out 1 or 2 of them that you think are correct. If you do that, that's great. And when you're ready to come back, we'll look at the explanation together because again, we are using these questions to learn about this material. So let's go ahead and go to the explanation if you haven't already paused the video. All right, here we are. The answer is B, increase the focus on inventory valuation, considering it a high-risk area for material misstatement. So when you're planning an engagement, this is something that you would do. When preparing an engagement plan, the auditor should review prior period audit findings to identify areas of heightened risk. A prior material misstatement, and we'll talk about material misstatements in not too long, in inventory valuation suggests an increased risk that requires additional attention in the current audit. Reducing testing, and that was option A, or assuming resolution, that was option C, would neglect the risk, and excluding inventory, which was option D, contradicts the principle of risk-based auditing. So you don't want to just ignore that there were material misstatements in the previous audit. You want to pay attention to those, and that will affect how you plan the engagement for the current year, because now you know you probably need to increase the focus on inventory valuation to make sure that a material misstatement isn't occurring again, or to make sure that you catch it if it is occurring again. So again, these are the things that you would need to consider when you were drafting an engagement plan. Now let's go to the next question to learn some more. All right, here we are at question 2. How should this impact the audit plan? Okay, let's go up to the top. While preparing an engagement plan, an auditor identifies that the client has implemented a new accounting system for revenue recognition during the current year. So again, how is this going to impact the audit plan? Let's go through the options. Option A, consider the risk of material misstatement due to system implementation and modify audit procedures accordingly. Option B, increase reliance on prior year audit work papers since revenue was audited in the past. Option C, reduce the level of substantive testing since the new system is expected to improve accuracy. Or option D, ignore the system change as long as management has provided assurance of its effectiveness. Okay, so if you don't know the answer to this, that's okay. We are going to go to the answer in just a second. But if you want, go ahead and pause the video, kind of think through this. Think of your own opinion or your own option that you think is correct. And when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is A, consider the risk of material misstatement due to system implementation and modify audit procedures accordingly. So this is something that would affect your plan. This is something that you want to take into account. Let's walk through this. A new accounting system introduces risks related to implementation errors, system controls, and data migration. The engagement plan should reflect this increased risk by adjusting audit procedures. Relying on prior year work, that was option B, would not address changes, and assuming accuracy improvements, that was option C, or relying solely on management assurance, that was option D, would be inappropriate. Again, when it comes to an audit engagement plan, you're paying attention to the prior year things and you're paying attention to the big changes in the current year, because that is going to inform you the procedures and the things that you're going to be doing, and that is going to be a part of you creating your engagement plan, your audit plan. So if there's a big change in the accounting system, that's not something you want to overlook. That's something that you want to pay attention to, because that could lead to material misstatement due to it being a new system, people not implementing it correctly, or whatever the case may be. So again, this is something you want to pay attention to in the engagement plan. Now let's go to the next question. All right, here we are at question 3. What is the appropriate response in the engagement plan? Okay, let's go up to the top. An auditor is assessing the risk of material misstatement for a client's accounts receivable. The inherent risk for the account is high due to significant estimation involved in the allowance for doubtful accounts. Control risk is assessed as low based on strong internal controls. So again, what is the appropriate response in the engagement plan? Now, if you don't really know much about control risk or inherent risk, that's okay. We're not going to dive super deep into those in this video, because those are things that we're going to cover much more in depth in future videos. But if you have an idea what those are, then reading through these options, you'll be able to kind of figure it out after I've read through them. So after I read through these, pause the video if you need to and come back when you're ready. But let's go ahead and read through the options. Option A, perform extensive substantive procedures despite the low control risk. B, rely entirely on controls and eliminate substantive procedures. C, combine risks of controls and substantive procedures to address risk effectively. Or D, assume low risk overall due to strong internal controls and reduce audit procedures. Okay, again, out of all those options, kind of thinking about control risk, inherent risk, if you know anything about those. If you don't know, that's okay. But after you've thought for a while, come back and we'll look at the answer together. All right, here we are. The answer is C, combine tests of controls and substantive procedures to address risk effectively. You know, that kind of makes sense. Not too difficult if you kind of read through these options and really think about it. Since inherent risk is high, substantive procedures are necessary to address the risk of estimation errors in the allowance for doubtful accounts. Just kind of briefly explaining, inherent risk is basically the risk that is there without anything else happening. This is just the inherent risk, just based on it being an accounting system, just based on it, the normal procedures of it. You know, it's just, this is inherently the risk. So they have to have, of course, substantive procedures to address that risk. However, because control risk is low, tests of controls can be used to gain assurance over the effectiveness of management's estimation process. Because the risk that the controls are bad is low, they can use the tests of controls to gain assurance, again, about the effectiveness of management's estimation process. Completely eliminating substantive procedures, which was B, or assuming overall low risk, which was D, would be inappropriate. You know, pretty much never are you going to eliminate the substantive procedures completely, while extensive substantive procedures, and that was option A, may be inefficient. You know, you may not have to do too much because, again, the control risk is low, so you can test the controls to find some things out. However, if control risk was high, then you would be less inclined to, you wouldn't trust the testing of the controls as much. But because it's low, you might not have to do extensive testing. You might not have to do extensive substantive procedures. That would probably be inefficient. So again, that's why you want to combine the test of controls and the substantive procedures. And that's something you would plan in your engagement plan, your audit plan. Now with that, let's go to the next question. Okay, here we are at question 4. Which of the following is the primary reason an auditor establishes specific audit objectives when preparing an engagement plan? Okay, let's go through the options. Option A, to ensure compliance with all client policies and procedures. B, to align audit procedures with the client's internal financial goals. C, to eliminate the need for substantive testing by relying on internal controls. Or D, to identify financial statement assertions that require audit procedures. Okay, so we've gone through some different things. I bet that based off of what you learned in the previous 3 questions, you could kind of work your way through this and think through these different options and pick at least 1 or 2 of them that you think are correct. So pause the video, think through this, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. D, to identify financial statement assertions that require audit procedures. So that is something that's one of the primary reasons that you establish these specific audit objectives when you're creating your engagement plan. Let's talk about the explanation. Audit objectives are established based on relevant financial statement assertions, and the financial statement assertions, we're again not going to dive super deep into those in this because that's something that will kind of just pop up throughout the rest of the videos, but those are typically existence, completeness, accuracy, valuation, and again, they are establishing objectives based on these for each process, account, or class of transactions. These objectives guide the selection of audit procedures, compliance with client policies, and that was option A, and alignment with internal goals, that was option B, are not primary purposes and eliminating substantive testing, and that was option C, is not appropriate. Again, pretty much never are you going to eliminate substantive testing. That's something that you're going to need because there's just always inherent risk. There's always something that you need to test for. Now, with all that, let's go to the next question. All right, here we are at question 5. What factors should be considered when setting performance materiality? So let's go up to the top. An auditor is determining materiality for the audit of a company's financial statements. So again, what is the factor that should be considered when they're setting that performance materiality? Let's walk through this. Option A, the threshold at which the financial statements will be audited without errors. Option B, the risk that the aggregate of uncorrected and undetected misstatements will exceed overall materiality. Option C, the level of internal control reliance planned for the audit. Or option D, the audit procedures that will be performed to detect fraud. So again, which one of these is something you would consider when you are trying to set up performance materiality during your drafting of an engagement plan? If you don't know the answer, that's okay. Again, we're using these questions to learn. So if you want, maybe pause the video and think through this, but if not, let's go ahead and look at the answer together. Okay, here we are. The answer is B, the risk that the aggregate of uncorrected and undetected misstatements will exceed overall materiality. That's something that you want to be considering when you are setting performance materiality, when you are drafting your engagement plan. So let's walk through this short explanation. Performance materiality is set lower than overall materiality to reduce the risk that undetected and uncorrected misstatements in aggregate, so in total, exceed materiality for the financial statements as a whole. It is not a measure of error-free statements, nor is it based on internal control reliance or fraud procedures. And again, these are all things that have to do with specifically when you are drafting an engagement plan. You want to consider performance materiality. You want to consider the other things that we've talked about in the previous questions. And now that we've gone over 5 questions considering this, let's do one more part of the SuperfastCPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2, 3, 4 questions trying to teach you about performance materiality, or maybe you've seen 2 or 3 or 4 questions trying to teach you about other things that go into drafting an engagement plan. Whatever the case may be, you notice these things throughout the questions and you can tell that they are important because again, you've seen them multiple times. So you write pillar topics based off of these. These are in your own words. Basically, it's a summary in your own words of the most important things you learned from the questions. And as you're doing this each day, you are building your own personal repository of the most important things you need to know for the exam in your own words, again, based off the questions. So with all that, now let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. And remember, this is all from the eyes or from the scope of drafting an engagement plan. So let's walk through this. Prior period issues. In drafting an engagement plan, auditors must revisit prior material misstatements or unresolved control deficiencies to pinpoint heightened risk areas and decide on the extent of current year testing. Now let's talk about changes in the client environment. Engagement plans should incorporate new accounting systems, significant operational shifts, or expanded territories to address implementation risks and untested controls. Now let's talk about balancing tests of controls and substantive procedures. Even when control risk is assessed as low, auditors must still address inherent risks like complex estimates. Things that, they're inherently complex, that's where things could go wrong, so they still have to address those. So they still have to have sufficient substantive testing to ensure reliable audit evidence. Now let's talk about setting materiality and performance materiality. Auditors establish thresholds below overall materiality to prevent an aggregate of small misstatements from surpassing materiality for the financial statements as a whole. And then finally, targeting relevant assertions. An effective engagement plan identifies which financial statement assertions, and again, those are completeness, existence, valuation, those are some of those, and again, those will come up again in future videos, are most vulnerable to misstatement so that audit procedures can be tailored accordingly. Now with that, we've gone over the pillar topics for this video, we've gone over the first 5 questions. Remember that SuperfastCPA Pro members are going to get access to the next 5 questions that I'm about to record after I finish this, because they get access to the full 10 question versions of the videos. So if you like this and you like our other videos and our other products, remember to check out becoming a SuperfastCPA Pro member to get access to the Pro course and the full versions of the multiple choice question walkthrough videos that we have on the forum. And one of the easiest ways to do that is by first going to superfastcpa.com and signing up for our free 1-hour webinar training. We will teach you the key ingredients to passing the CPA exam, and that is a great path to learning more about SuperfastCPA and ultimately becoming a Pro member. So again, check out the webinar, check out becoming a Pro member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.